Hello. In this video we are going to understand the whole history of Japan's economic crisis. Imagine, Japan is like a big toy factory. A long time ago, this factory was making lots and lots of toys, and everyone wanted them. People were so excited about these toys that they were willing to pay a lot of money for them. But then something went wrong. The factory started making too many toys, way more than people actually wanted. So, the toys became less special, and fewer people wanted to buy them. This made the factory owners worried, because they had already spent a lot of money making all these extra toys. Now, when people don't want to buy as many toys, the factory doesn't make as much money. And if the factory isn't making much money, it can't pay its workers as much, or buy new machines to make better toys. To make things even trickier, the people who lent money to the factory, like banks, were worried they might not get their money back, because the factory wasn't doing so well. So, they stopped lending money to the factory and others like it. With fewer toys being made, and less money being spent, the whole town started feeling the pinch. People didn't have as much money to spend on fun things, so they stopped going out to restaurants, or buying new clothes. This made the problem even worse, because now, even fewer people were spending money. The government tried to help by doing things, like giving out money, or building new roads, to make the town more attractive. But it was tough, because they had to figure out how to fix the toy factory, and get people excited about buying toys again. And to make matters even more complicated, there were fewer and fewer young people around to work in the factory, because most of the town's population was getting older. This meant there weren't enough new workers to replace the ones who were retiring. So, to sum it up, Japan's economic crisis was like a big puzzle, with lots of pieces, too many toys, not enough buyers, worried lenders, and a shrinking workforce. Japan's descent into deflation can be traced back to a combination of factors and events spanning several decades. Here's a historical overview of Japan's path into deflation. Asset price bubble. In late 1980s. The roots of Japan's deflationary spiral can be traced back to the late 1980s, when the country experienced an extraordinary economic boom. During this period, asset prices, particularly real estate and stocks, soared to unsustainable levels. The bubble was fueled by excessive speculation, easy credit, and lax regulatory oversight. Bursting of the bubble. In early 1990s, the bubble economy eventually burst in the early 1990s, leading to a sharp contraction in asset prices. Stock prices plummeted, and land values collapsed, leaving many banks and financial institutions saddled with non-performing loans. This period marked the beginning of Japan's prolonged economic stagnation. Banking crisis. The collapse of asset prices triggered a banking crisis as financial institutions faced mounting losses on their portfolios of bad loans. In response, banks tightened lending standards and became more risk-averse, further dampening economic activity. The government intervened with various measures to stabilize the financial system, but the banking sector remained fragile for years. Monetary policy response. The Bank of Japan, BOJ, responded to the economic downturn by implementing accommodative monetary policies, including lowering interest rates to historically low levels. However, these measures were insufficient to counteract the deflationary pressures gripping the economy. Liquidity trap. Japan entered what economists call a liquidity trap, where nominal interest rates are at or near zero, but economic growth remains subdued, and deflation persists. In such an environment, conventional monetary policy tools become less effective, because there is little incentive for businesses and consumers to borrow and spend, even when interest rates are low. Fiscal stimulus. To combat deflation and stimulate economic growth, the Japanese government implemented various fiscal stimulus packages over the years, including infrastructure spending and tax cuts. While these measures provided temporary relief and supported aggregate demand, they were unable to address the underlying structural issues contributing to deflation. Demographic factors. Japan's rapidly aging population has also played a role in exacerbating deflationary pressures. With a shrinking workforce and a growing elderly population, consumer spending patterns have shifted, with older individuals saving more and spending less. This demographic trend has contributed to weak domestic demand and deflationary tendencies. Expectations of deflation. Over time, expectations of deflation became entrenched in the Japanese economy. Consumers and businesses anticipated falling prices in the future, leading to a self-reinforcing cycle of reduced consumption, investment, and economic activity. Breaking this cycle of deflationary expectations has proven to be a significant challenge for policymakers. Overall, Japan's descent into deflation was the result of a confluence of factors, including the bursting of the asset price bubble, the subsequent banking crisis, ineffective monetary policy responses, demographic shifts, and entrenched expectations of deflation. Addressing deflation required a multifaceted approach, combining monetary stimulus, fiscal measures, and structural reforms aimed at promoting sustainable economic growth and price stability.